Hello there, welcome to Market Call. Today we have the return of Robert McWhirter. He hasn't been on since 2021. He is president of Selective Asset Management, and Robert will be taking your questions on Canadian dividend stocks. You know that number, 1-855-326-6266, or you can email us, marketcall@bnnbloomberg.ca. Welcome back.
Thank you. Glad to be here.
We are excited to have you. Let's start off with the US dollar, though, because its decline has caught attention. Do you think there has been a retreat from US assets because of political unpredictability?
A little bit of a decline in participation in the U.S. assets, but more for foreign investors. They're now hedging their exposure on the currency, which then puts further pressure on the U.S. dollar. President Trump has also said that he would like a lower U.S. dollar to make U.S. goods more competitive.
Has he been explicit? I've lost track.
I think it was back in the kind of early portions of it, but yes, I think it's there in the background. It is down 10% year to date, U.S. dollar, and it looks like it's starting the potential of a further secular decline, meaning even more lower to come. Because of that, we have a significant investment in 3 gold stocks in the Canadian Conservative Growth Strategy. Price of gold is currently roughly $33.30, up about 27% year to date, and we think there's still more upside because of central bank buying as well as the expected further weakness in the U.S. dollar.
You do have a gold idea for us coming up. Is it partly the U.S. deficit? Is that going to weigh on the greenback?
I think so, because the U.S. deficit, from recollection, is around $34 trillion. The new BBB budget is, from recollection, going to continue with a U.S. deficit, $1.4 trillion per year. And that then is going to cause further concerns about the ability of the dollar to be able to kind of have repaid. And there's also a trend that's been in place for about 4 years where central banks are using gold as a alternative to the U.S. dollar for their reserves to back up their own local currency.
Maybe we'll pop up a 5-year chart for the Bloomberg Commodity Index, which has a pretty high weighting in gold. I mean, it's always a question of how you construct these benchmarks.
Right.
But you think that there is evidence of an uptrend in commodities?
Yes, particularly in copper, which is a byproduct of gold, but also a lot of it is used in the renewable energy space and automobiles, as well as house construction. And looks like copper now is kind of above $5, and technical analysts suggest it may end up heading towards $10 over the next couple of years.
$10. Yeah, we know that the world will have enormous difficulty increasing copper production, given the cost and the declining quality of deposits.
Yes, and no new mines, generally speaking, have been created for a long time. And because of the kind of variation in the kind of outlook for the price of copper. But I think you're now going to see a lot more mines being started or restarted as well.
That's interesting. We see Barrick Mining, for example, making a big deal about moving more heavily into copper.
Well, back probably 7 to 10 years ago, Barrick had said, look, the amount of gold that you can get out of a piece of rock has declined from 6 grams per ton to maybe 2 grams per ton. And in their view, copper was a more stable product to be able to kind of get into. As a result, when you end up seeing gold moving up, Barrick doesn't move it up as much as some of the other large gold stocks.
We are going to be back with Robert McWhirter of Selective Asset Management, taking your questions on Canadian dividend stocks. 1-855-326-6266. We have an email from Brian. I'd like your choice on Choice Properties REIT for a long-term hold in my TFSA account. Let me look up the symbol. It slipped my mind for Choice Properties. There we are, CHP.UN, obviously a retail-flavored REIT.
Okay. So just as a backgrounder, the strategy that I use is based on a quantitative system that was privately owned, then acquired by Morningstar, and about 2 years ago was acquired by Innovestor out of Montreal. CPMS is the base system. So it uses a variety of quantitative, fundamental, and technical factors to end up using and ranking stocks. So one of the interesting parts is that over the last 3 months, basically looked under the hood and said, okay, it's all about free cash flow. And if you were looking at the free cash flow for the typical stock, free cash flow yield would be about 3.7%. Compare that to Government of Canada bonds around 3.5%, so you're going not great. And then the other portion, even more surprising, is the return on capital, free cash flow divided by effectively debt plus equity. That is literally 1.1%, so about 1/3 the yield that you would get on Government of Canada bonds. So my comments in many cases today will be, how does the stock rank in the overall quant system, and also how does it compare to the return on invested capital using free cash flow yield? So I did have a chance to look at the stock earlier, and Andrew, if you can tell me the symbol once more.
It's a Loblaw affiliate, as you know, CHP.UN. It was spun out of Loblaw's to hold some of their real estate assets, CHP.UN. And I'm going to look up the yield now. That is interesting, though, looking at the return on capital, combining equity and debt. Maybe we can talk more about that later. I do find it fascinating, the prospects for retail. Quite a few strip malls around Toronto, as far as I know, are actually closing and are becoming condos because of lack of return.
Okay, so the yield is on a dividend of 76 cents, about 5.1%. Payout's about 73% of cash flow. Dividend has been increased slightly over the last year. No estimate revisions upwards over the last couple of months. And if you look at the price earnings multiple, it's basically on 2025, round figures 15 times against current year estimate growth for earnings of 2.4% and next year of 5.6%. So the whole point of investing in any dividend stock is to end up saying, all right, how's the underlying business going? Are they growing sales and free cash flow to be able to increase my dividend over time? And with an increase of sales over the last year of just under 3% and cash flow from operations about 6%, they're not ripping the leather off the ball in that kind of opportunity here. The return on invested capital, free cash flow compared to overall capital, is literally 0.3%, so even less than the typical stock. So overall, the rank is basically in the kind of borderline of the top third of the database, but it ranks a sell at the moment because there are other stocks on a total return basis that I think will give you a better risk-adjusted long-term return.
We have a caller from Edmonton. Jerry, go ahead, please.
My question is on Pembina Pipeline. Do you own Pembina Pipeline, and do you like the pipeline space? Thank you very much. Have a nice day.
PPL.
Okay, PPL was held in the Canadian Conservative Growth Strategy up until about 3 months ago. At that point, the stock was hitting effectively one-year lows in spite of the kind of opportunity for the company. As a result, we basically moved into a gold stock at the time, which has done fairly well for us. Now, if I can get it to come up in the database, which of course it's not.
Let me check the yield on Pembina, and it's been a pretty strong stock over the past 5 years. You can see up more than 50%.
Okay. Anyways, this is.
I'm showing a yield of, hang on, let me check that again. Still stalling?
Unfortunately, yes.
No problem. What about your thoughts on pipelines in general? Do you have any guidelines if people are considering a pipeline?
Yes, don't, which is another one. I'm saying that because when you look at, of all the stocks that are in the TSC, there's about 230 in the TSC composite. Then you end up saying, okay, how many pay a dividend? So that gets due down to, I think, around 120. And then it becomes one of going, okay, how many are in the category that have free cash flow yields that are above average and growing, and that gives you to a list of about 25 to 30 stocks. So when you look at the okay to buy list, there aren't any pipeline stocks that are in the current okay to buy list in any of the work that I'm doing. So nice, but hopefully there will be other opportunities to be looking at.
a yield of 5.6% for somebody who is just looking for a dividend, though. What about that? I mean, would you be less concerned about a cash flow yield that's not growing very much?
Yes, because the whole point is you end up saying to yourself, okay, if I do have a dividend, it's nice. The kind of question is, all right, they have increased the dividend by about 3%. Over the last year. Their payout is reasonable at 46% of cash flow, trailing yield 5.4%. The concern becomes when I'm going, okay, is there going to be enough growth to really be able to increase the dividend over time? The quantum model effectively says, again, you'd be better looking at other opportunities. It ranks 147, so it's midpoint of the top kind of 1/8 of the database. But again, overall, it suggests you should be looking at other stocks.
We have Colin, one of our longtime viewers, calling from Sarnia, Ontario. Go ahead, Colin, please.
Well, thank you, and good afternoon to you fine gentlemen.
Thank you very much.
My question is about Propel Holdings. I'd love to know where it fits in your ranking of 700 or 800 stocks, and any other details you'd like to share with us, much appreciated.
Thanks. Well, that's the online lending platform, yield of about 2%.
Can you tell me the stock symbol? Because I'm not
sure can. Yeah, PRL. PRL.
Thank you. My apologies. This is driving me nuts. All right, I'll go back to. My apologies, I created a custom shortcut, and it's not.
So off its highs, but certainly popular with investors, up 60% in the past year, and a market cap of about $1.5 billion. And I seem to remember they use AI, or they said they use AI to look past the normal criteria for lending.
Unfortunately, it's not in the database.
Okay, no problem.
Sorry.
Oh, well, we got plenty more fish in the sea. We're going to be right back with Robert McWhirter. He is taking your questions on Canadian dividend stocks. Right, let's head to Montreal. Joe, go ahead, please.
Thank you, Andy, and good to have you back, Robert. I want to ask you about TD Bank. I'm retired. I have it in my non-registered cash account, and I bought it in the low 80s, and it's gone up very nicely now. Mm-hmm. But my concerns are if, with the continuing tariffs battles and the other issues going on politically, whether I should be taking some profits here and redeploying it. I've never done this before, but redeploying it to the worst performing Canadian bank, which I believe is Bank of Nova Scotia right now. And would this be something you think I should consider? Or do you have another idea for me because of my concerns about this starts going south at some point in the near to medium term? Thank you.
Thanks very much.
Okay, so TD is ranking middle of the pack as far as the overall kind of rank. Their earnings estimate growth is 8% for 2025 and a further 5% for 2026. So with that, you kind of figure, okay, am I looking for something that hopefully can grow the dividend by better than 5 or 6%? The answer is probably. Overall, if you were to consider a switch, I would suggest you consider TD into Bank of Commerce, because Commerce has basically popped up in our work occasionally. It's not on the current buy list, but it has been within the last kind of month and a half. Overall, year over year, sales for TD are up a moderate 2%. Free cash flow down 21% year over year, and free cash flow yield of 2%. And the overall kind of return on invested capital is literally less than 1/4% So when you look at the kind of comments from earlier, it's approximately 1/4 of the return on capital compared to a typical stock, and much less than there are in other opportunities in the investing total return concept stocks.
Okay, and we are, of course, going to get 3 ideas from you in top picks at the end of the show. Let us, we have an email here. This viewer wants to know about CLS. Stephen is asking, is Celestica still a buy at these levels? It has been pushed higher by AI enthusiasm.
Okay, Celestica is not a dividend-paying stock.
No.
They are an assembler of basically the materials for data centers. There is a high correlation between what they have been able to achieve and the outlook of NVIDIA. They have also, in the past, started to diversify away towards more stable, recurring revenue kind of opportunities being designed in. With that, if you're looking for income and overall total return, I would suggest that some of the other stocks that pay dividends typically then have lower volatility and then have, as a result, higher likelihood of the kind of outcome you're looking for. Because unfortunately, Celestica could be, better or worse. Versus Technologies, a Canadian company, VERS, is a small company that's working on a different method of machine learning and AI. If they are successful, then very similar to what occurred approximately 9 months ago when the Chinese said, hey, we've got a different model, we can use less computing horsepower, and as a result, there was the big pullback in NVIDIA, and the question is, okay, are there further developments like that that will use less computing power and less electricity going forward? So, again, overall returns, maybe, but if you're looking for income, you'd be looking for other stocks with less volatility.
I think that stock you mentioned was Verses AI, VERS. I'm not 100% clear. It trades on the NEO exchange, is it? Do you know? Or?
Yes.
Yes, okay, thank you. VERS on the NEO. Thank you very much for that email, Stephen. Let's go to Gordon in Victoria. Thank you very much for calling. Fire ahead, Gordon.
Good morning. Algoma Central, dominant shipper on the Great Lakes, young fleet, good dividend, regular increases, meaningful if sporadic stock buybacks, and a dominant shareholder who looks to me like it's a good possibility he's going to take it private at some point. What are your thoughts?
Okay, and the yield on that one just under 5%.
Can you tell me the symbol? Because I'm not...
I sure can. ALC. ALC is the symbol on Algoma Central. I don't remember the last time we talked about this stock. Market cap of about 650 million, and the share's up about 14% in the past year.
Unfortunately, it's not in the database.
It's not coming up? Oh, okay. No problem. We should try to have them on because Great Lakes shipping, I'm always interested. I see these tankers go by and I always wonder, what are they carrying? I was going to ask you something just philosophically. Do you have thoughts on stock buybacks versus dividends? It's a very broad question.
Generally speaking, the kind of cash in your hand is preferred. Yes, stock buybacks will end up reducing the number of shares outstanding, which then will typically end up increasing the sales per share, earnings per share, cash flow per share, free cash flow per share. When I have done historically a back test that says, okay, if we use what's called the buyback yield, which is a combination of number of shares bought back plus cash dividend, and compare that to just the cash dividends, the returns basically are better when it's blended in with all the other factors in the model when you use just the cash dividends, because there's more consistency to it as well.
And it always seems there's something of a built-in conflict there. They're using money, the company's money, to inflate the share price.
Well, not so much inflate the share price. The question becomes one of, okay, if there are some companies when literally 1/3 of the company is in cash, they're pushing up a huge amount of free cash flow, and they end up doing a Rodney Dangerfield and saying, look, our stock is grossly undervalued, underappreciated by the marketplace, we'll buy back shares. In that case, it makes sense. On the other side, if it's extremely overvalued, you kind of go, that doesn't seem to be an efficient use of company funds. So part of what's going on in the background is if the company's return on invested capital is 15%, and you say, okay, if they were to use that free cash flow to buy back shares, yeah, it's probably an efficient use of capital. On the other side, if it's a much lower amount of return on invested capital, you'd say, look, you're probably better to try and end up using the money in a more effective way to have more, effectively, more to the bottom line for the company.
We're going to be back with Robert McWhirter. You can call in anytime, 1-855-326-6266, or email us, marketcall@bnnbloomberg.ca. And Robert is taking your questions on Canadian dividend stocks. We'll be right back. We are back, and now Robert has not been on since 2021, so we're not doing past picks, but let's get more on those pretty surprising numbers he gave us at the top of the show about low returns on capital for quite a few public companies. We have heard criticism of institutional investors and our giant pension funds for having a low exposure to Canadian stocks. Now, according to data from InnoInvestor CPMS, typical TSX stock has a free cash flow yield of about 3.7%. It's only about the same as the yield on a 10-year Government of Canada bond. And then the return of capital, and this was surprising, I thought, this number, a tiny 1.05%. And that's only 1/3 of the current yield on a 10-year Canada. So Robert argues that it's not surprising that some institutions may be reluctant to overload on Canadian stocks. He says, though, he has been able to dig out dividend-paying stocks that have a typically have an above-average growth. So talk to us first about that low return on capital, debt plus equity.
It's frustrating. And the other portion is, you've got to remember that the pension plans, Canada Pension Plan and others, the money that they run is so big, it's scary. So if they showed up and said, Bob, we have a gigantic check for you to basically invest in the Canadian Conservative Growth Strategy, my comment would be, okay, that's nice, but the maximum we can run in this thing is about $500 million. And they'd say, well, that's like 1/10 of 1% of our portfolio, so that's not going to work for us. So there's two things. One, the ability to end up investing huge sums in Canada, particularly in publicly traded companies, and two, to try and get above average returns. So a lot of what they do is infrastructure related or kind of private investments in opportunities outside the four walls of Canada. So it makes sense because of the fiduciary responsibility that they have to end up saying, okay, we're going to try and get the best possible return. Interestingly, the UK is going through the same risk wrestling of, oh, gee, how come large investors and pension plans aren't investing in the UK? And I'm sure it's for the same reasons that you can get better risk-adjusted, better returns outside the four walls of either Canada or the UK. And, to be fair, the Canadian stock market is about 3% of overall world market cap. So it's pretty tiny if you're running huge amounts of money.
Nevertheless, we see Canadian tech stocks being taken out, a whole bunch over the past year or two, at huge premiums, implying that these companies are undervalued. Could they not allocate a bit more of their money? I realize it's chump change for some of these big players.
Well, the challenge with small cap tech companies is that a lot of them are consumers of cash, and it becomes one of going, okay, can I end up, producing value over time? There's a professor in the U.S. who basically says, look, if you go back 100 years, only 2.4% of all the stocks in the U.S. are the ones that create the value when basically the market goes up approximately 7% per year. So if you end up saying which is why in part it makes sense in the U.S. to end up saying, okay, I'm going to be an index investor and buy the S&P or the NASDAQ ETF. When you're trying to do that pick private companies and try and figure out which ones are doing well. You've seen in the headlines in the last couple of weeks, a robotics company in Canada has gone under and a variety of other companies. So when I was running the private equity money as part of Royal Bank Investment Management's portion, it was maximum 1/10 of the whole overall portfolio across approximately 15 stocks. And my comment to my partners was, look, you'll find probably 3 of these stocks will do really, really well. 3 stocks not so much, and the rest are going to be walking dead. And the hard part is, trying to end up valuing them over time and trying to find the needle in the haystack that's going to do well. So the portion is yes. Going back to the kind of days of both Nortel and Newbridge, they'd end up saying, hey, we've got overvalued paper or currency of our own, and we're going to offer stock to acquire a company that will fit in with us. One of my partners said, oh my gosh, this is terrible. I said, well, if you bought a wristwatch and it was 1% of your personal wealth, and the wristwatch was $1 million and it was only worth 10 grand, and you found out it was only worth 10 grand, is it going to wipe you out? No. And a lot of the acquisitions that are done of technology companies are a very tiny, tiny portion of the overall market cap of the company that's acquiring them. And their whole purpose in life, in many cases, is to say, hey, we've got great technology, meaning we acquiring great technology, we can add that then to our customer base, get greater share of wallet from our existing customers, and have it all make sense. That is, something where it makes sense for people to acquire, but more difficult for pension plans to make money.
We're going to be back with Robert McWhirter of Selective Asset Management, taking your questions on Canadian dividend stocks. Let's head to Burnaby, BC, beautiful part of the world. Debbie, go ahead, please.
Hi, good morning. I'd just like your comment, please, on Gibson Energy, and if it would be a buy or a sell. Thank you so much. Bye-bye.
Right-ho. Stock under pressure lately, I think, down from its highs, and the yield just over 7%.
So in the overall quant model, it ranks 325, which is middle of the pack. It's shown as a sell. The stock is about 9% off its high. It's still above its 200-day moving average. On the other side, as far as making money, the quarterly sales momentum, which is the most recent 4 quarters compared to 1 quarter, is minus 5%, which then causes, the sales are minus 5%, cash flow is minus 5%, and there are concerns as to whether or not the kind of price of oil is going to be maintained or not. So the overall free cash flow yield about 2.5%. Again, that's pretty modest. Yes, it's above standard, but in the overall scheme of life, I would be looking at other energy stocks or oil companies. In our model, Imperial Oil ranks better from a total investment opportunity basis.
Let's go to Gulam. He's in Toronto. Gulam, fire ahead, please.
Hi, good afternoon.
Hi.
My question is on Freehold Royalties. I know that they pay a pretty good dividend. I'm not sure about capital appreciation in that industry, but my strategy was to sell some of my TD stock, which have gone up to about a 52-week high, and put it into Freehold Royalties for a good dividend. Is that a good strategy, or would you buy the Freehold Royalties at the current price? I'd appreciate your suggestion. Thank you.
Thanks, Gulam.
Okay, so the overall rank is 422, so it's in the bottom half of the database. The payout is probably sustainable at about 68% of free cash flow. Overall, the sales and cash flow, the quarterly sales momentum is a modest 3%. Cash flow is 4%. So as a result, when you end up saying, gee, we're looking for and hope for kind of above average returns over time, or at least returns to keep a pace of inflation, not so much. And the return on capital, unfortunately, is negative. So I would give it a pass.
Oh, okay, you're passing on that one. We have a caller in Scarborough, Ontario, wants to ask about IFC. Robert, go ahead, please.
Yes, hello, gentlemen. Thanks for taking my call. My question is on Intact Financial, IFC. I've been trying to buy this stock, but it always seems to be going up. It doesn't correct itself.
It's frustrating. I know that feeling. Yeah, go ahead. Sorry, Robert. Yep.
So would you, looking at this stock for the next 5 to 10 years, would you buy this stock at this price?
That's interesting. Yeah, always expensive, but doing well.
Okay, so with investing, the methodology that I use has a turnover of approximately 1 times per year. So that means that some stocks will be held for a long time. Some of the gold stocks that we own in the portfolio, as an example, Kinross has almost tripled since we purchased it about 18 months ago. On the other side, some stocks come and go. So when you end up saying, gee, Bob, what can I buy with a 5 or 10 year outlook? Other than potentially Dollarama, there are a few stocks that come to mind that would end up having that time frame.
It's interesting, these low return on capital numbers. I mean, suggesting if I have a pile of money, I might be better off just buying a government bond?
Yeah, again, the challenge becomes one of you're trying to get the best risk-adjusted return over time. There are a number of companies that will provide that in a diversified portfolio. Intact kind of ranks within the almost okay to buy list. But overall, I think, again, there are other companies in other industries.
The next one has a symbol of FNV. Mark in Gatineau, go ahead, please.
Oui, bonjour, monsieur. Thanks for taking my call there, Rob. Good to see you back after 4 years.
There you go.
I've got a question on FNV, and just an add-on question. Are you as bullish in the silver sector as you are in the gold sector? Thank you kindly, and have a good day, and good to see you back, Rob.
Franco, Nevada.
Okay, so let's ask the silver versus gold question first. There is a report that looks and says, how does silver performing versus gold? The answer is, has been terrible. Now it looks like it's basically turning the corner. As a result, you look and say, okay, if you had the opportunity, you'd probably end up buying silver versus gold, but there are no silver stocks that show up in any of our top 25 okay to buy stocks, if you will. There's lots of gold stocks, but no silver. So yes, with that kind of caveat, silver will probably do well. On the other side, people typically aren't buying silver as a central bank. They're buying gold. And I think the gold market, again, in my view, because of all the various fundamentals, provides an opportunity. Goldman Sachs about 2 months ago said if 1% of all the assets in the world shifted from your choice stock, bonds, real estate, private equity into gold, gold would be at $6,000 US. So it doesn't take an awful lot of kind of movement, if you wish, for people to end up impacting on the price of gold. Turning to Franco-Nevada, it ranks 226, which is a hold. If you're looking for a gold stock, there is a specific name that we will be talking about later on in the 3 picks part of the show that I think offers a better opportunity than Franco-Nevada. Remember that they own some of their own mines, and they basically have effectively lent money against kind of future receipt of physical gold and or cash flows, if you will. It's an interesting business model, but I do think if you're looking for a gold play with reasonable opportunity to participate in the gold, maybe headed towards $4,000 from the current roughly $3,300, and as a result, I think you're going to get better risk-adjusted returns in other stocks.
Okay, we've got to take a break. We're going to be back with Robert McWhirter taking your questions on Canadian dividend stocks. We have a caller, Frida, in Chilliwack, BC. Frida, go ahead, please.
Hi, I'm looking for Black Gold, Tamarack Valley, PDE.
Black Gold, Texas Tea, Tamarack Valley, the oil producer.
Okay, so this is a stock that is below the kind of minimum market caps. It's $2.4 billion in round figures. The market cap for a strategy is 2.8. That being said, the stock ranks well at 192. The dividend is 15 cents. The yield is roughly 3.1%. The payout is modest at 9%. Effectively, earnings surprise in the most recent quarter was up 9%. Estimates basically have not been revised upwards. The stock appears to be reasonably priced at 3.6 times enterprise value to cash flow. And when you look at the kind of trailing cash flow, that gives you almost like price earnings to growth. But when you use enterprise value to cash flow per share growth, or EVCFG, it's 0.12, and any measure that's less than 1 is being viewed as attractive. That being said, earnings estimates are expected to decline by 45% this year and 63% next year. So, however, the underlying cash flow from operations is up 31%. So it's really a question of, do you think the price of oil is going to $50 or $80? One of the technicians from the group that basically sends me materials suggests that we would be headed back on a trade towards $76 because of the uncertainty longer term of what's going on and the kind of uncertainty with the price of oil. I'd be looking at, again, something else. In my work, Imperial Oil, again, ranks better in the overall quant system.
IMO and oil right now just under $68 US for North American crude. Let's go to Joel in Hamilton, Ontario. Joel, fire ahead, please.
Yes, I have invested in BCE, and I took an awful hit in my roof. Is it ever going to come back, or should I sell it?
Thanks. And, of course, BCE, the parent of BNN Bloomberg.
Okay, so one of the questions later on the show will be about technical analysis. And there's a description that says, nothing good happens below the 200-day moving average. And the reason for saying that is because at the moment, BCE is trading at 13% below the 200-day moving average. The overall dividend yield, 5.7%. Payout is approximately 45% of the kind of forecast going forward. Earnings estimates glacially increased by basically 0.2% going forward. And enterprise value to cash flow, 8.7 times relative to growth, 0.3, so semi-attractive from that viewpoint. Earnings expected to go down 8% this year and 5% next year. So storm clouds on the horizon. The biggest challenge with BCE, Rogers, TELUS, the whole group is it's a very competitive business. They have a huge amount of assets in place. They're under attack from people delivering directly from satellite to your phone and kind of other opportunities. Yes, you've seen BCE sell off a chunk of their sporting chunk over to Rogers. But overall, a lot of these companies have extremely high debt to equity and unused assets that it's almost like having the car sitting in the driveway. It doesn't usually get used all that much, and that is difficult in this industry because it's so competitive to end up picking and having above average returns. Will it potentially go up? Maybe, but I think you'll get much better risk-adjusted returns in other stocks, including some of the 3 stocks we'll be talking about later in the show.
Let's head to the ticker symbol on this one, ATD. Let's head to Montreal. Go ahead, Gino, please.
Yes, happy Monday. Hope you're doing well, and thanks for taking my call. I've had Couche-Tard now for a number of years, and it's done very well. I've seen it come down quite a bit from the beginning of the year, and it's creeping up slowly. But I'm just wondering what your take on it is, and where do you see it? I see some of the analysts saying that it may hit 82 again, but curious to know what your take is on that.
Thanks.
Okay, so at the moment, the big portion with Couche-Tard is it continues to be a growth by acquisition company. To the best of my recollection, they're attempting to buy the kind of Japanese arm of some of the 7-Elevens that they already own in other parts of the world. Those discussions are ongoing. The company's been extremely disciplined about not overpaying. That's probably the kind of greatest kind of piece to be looking at it. Overall, enterprise value to cash flow 12 times compared to cash flow growth going forward. It ranks 0.82, so just below 1, so semi-attractive from that viewpoint. That being said, the price earnings multiple for this year is just under 18 times against 8% 8% earnings growth. And on a PEG basis, PE to growth compared to earnings growth is 2.3 times. Next year's earnings expected to grow by 15%, which compared to the 15 times PE gives you a 1.0 PEG. So overall sales growth up 1%, efficiencies up 16%. One of the biggest concerns becomes one of what's their cost of fuel, because That's where they get a lot of their margin, because a lot of their convenience stores sell gas as well as other products. Again, on an overall basis, I'd suggest that you might look at other consumer-related stocks in contrast to Couche-Tard.
Okay, I think we are out of time for calls. Well, we're looking forward to it. Drum roll, we're going to get Robert's top picks after this. Join us tomorrow on the Market Call. Our guest is Javed Mirza of Raymond James, and he's taking your questions on technical analysis. You can get in ahead of the pack with an email to marketcall@bnnbloomberg.ca. And if you missed Market Call, as if that could ever conceivably happen, maybe in some virtual universe, check out our daily podcast. It's on iHeartRadio and other podcast platforms, and you can watch full episodes on our YouTube channel. Robert's first idea is Atkins Realis, the big engineering company.
So the stocks, the three picks are being presented in alphabetical order, just so we get that out of the way. The company's doing well. They provide or have a great opportunity in kind of the nuclear side. President Trump is basically putting the shoulder to the wheel with regard to nuclear. There are a large number of extremely large companies with data centers and AI that have said, okay, we need to basically get to a stable, reliable energy source. Nuclear is the kind of what's being suggested there. Meanwhile, they're actually making decent money in the near term. So overall sales per share on a year-over-year basis are up 13%. Free cash flow per share grew at 157%. In the most recent quarter, that was a 7% earnings surprise, and earnings estimates have been revised up by 6% in the last 3 months. The return on free cash flow is, on a trailing basis, 7.4%, which is almost 7 times greater than the typical TSE stocks. The price earnings multiples for 2025 and 2026 are 32 times and 25 times, so you kind of go, oh, gee, there's fairly big, but the earnings growth forecast per share is 39% and 27%. So when you put the price earnings divided by the earnings growth, you get a PEG ratio of 0.8 times 2025, 0.9 times 2026. And again, anything viewed less than 1 times is viewed as attractive. And Mark Darrett, who's one of the top-ranked quantitative analysts in Canada, ranks ATRL in one of his top 10 quant picks within the last week.
Let's go on to bacon, one of my favorite topics, Maple Leaf Foods.
Well, Maple Leaf Foods is a leading protein company in Canada. They make a whole bunch of different food products that employ roughly 13,500 people in Canada, the US, and Asia. And they are spinning out the bacon division.
Right.
In part, that is expected to increase profit margins and reduce earnings volatility. There was a piece in the Financial Times of the UK about a week ago and said, okay, chicken sales are really starting to pick up. It's a less expensive, approximately half the price per pound compared to beef. And I think that will give Maple Leaf an opportunity. Their year-over-year sales, most recently per share, up 8%. Free cash flow per share up over 100%. Earnings surprise in the quarter, 17%. Earnings estimates are revised up by 15% in the most recent quarter. Free cash flow divided by capital, 8.5%, which is, again, approximately 8 times greater than the typical TSE stock. 2025 PEs are 17 and 2026, 14. Earnings growth, 109% this year, 18% next year. So when you look at the PE to growth 25 and 26, that's 0.2 this year and still an attractive 0.8. Remind him again, less than 1 time is viewed attractive. Tony Popovich, who's a technical analyst at Ventum Financial, recently noted that Maple Leaf stock is breaking up through a primary downtrend. It's been drawn off late 2017, so almost 5 years ago. And that was their high back at the time of $28. The target is $36, implying about 26% potential upside. Last but not least, Oceana Gold.
Okay.
We own this stock in the Canadian Conservative Growth Strategy. My wife owns it personally in her holdings as well. It's an intermediate gold and copper producer. It's got 4 mines, 1 in South Carolina, 1 in the Philippines, and 2 in New Zealand.
What about that jump lately? Can you account for that?
Yes, the stock has zoomed up.
Sorry.
People are paying attention. We bought the stock approximately 4 months ago. The stock is up approximately 55% since then. When they reported their results, the kind of earnings surprise was 18%, and earnings estimates have been revised upwards by 19%. The reason that you're seeing, in my view, the stock kind of zooming is that on a relative basis, this stock, in my view, is a table-pounding buy.
Oh, okay.
So free cash flow divided by capital, 30%, 28 times greater than the typical stock. The PE for this year and next year, 8.3 times and 5.7 times. Earnings growth forecast, 98% this year, 46% next year, gives you a PE to growth of 0.1 for both years. So when you look at it more from enterprise value to cash flow is what's used for gold stocks, trades at 4.3 times. Lundin basically is 4 times more expensive than that. So with you get an opportunity with OGC to do well. So a small cap stock, we own it. We think it's extremely attractive.
And they also did a 3-for-1 rollback, a consolidation in late June. Thank you very much, Robert. It was great to have you back. Thanks very much for watching Market Call.